I'm Jide Wintoki, Dean of the School of Business and the Henry D. Price Professor of Business, and I'm also a Professor of Finance here at the KU School of Business.
I'm Ryan Clark. I'm an Assistant Professor of Finance at the University of Nebraska-Lincoln College of Business and a recent graduate of the PhD program here at the KU School of Business. Our paper is Inferring Corporate Insiders' Beliefs about Firm Value from Their Tax Withholding Elections. And really kind of the core contribution is looking at this idea that the choice of how an insider withholds their taxes tells us something about what they believe the true firm value or the upcoming firm value is going to be. The idea for the paper that we're currently working on really started while I was teaching a class here at KU. So one of the things that KU really emphasizes is some of that experiential learning and getting students really working with real data. And so as part of teaching the corporate finance class, I subscribed to a bunch of SEC newsletters. And so I would get alerts as companies would make their filings. And one thing that I've really been interested in since taking your corporate finance seminar was insider trading, this idea that corporate insiders, CEOs, CFOs know a lot more about their company than the rest of the investing public, and they have the opportunity to potentially trade on that information and make profits, which is against laws in the US and most economies. And one thing that I noticed is that when these executives would receive stock options, sometimes they would choose to withhold stock, they would sell stock to cover their taxes. And then one day while I was teaching, I got an alert that this CFO had received a big stock award and chose not to sell any stock to cover the taxes. And I didn't really think anything of it. I mean, I just made kind of a mental note, but didn't really stick out. And then a couple days later, the company came out and made a couple of announcements. They announced some share repurchases and a couple of other things that made the stock go through the roof. I mean, I think it went up 15-20% over a couple week period. And that started getting me thinking that that was a really convenient time for that CFO to choose not to sell their stock, that they kept all of that stock and now all of a sudden it's worth a whole lot more money. I wanted to then get your opinion and see if that was maybe something that happens more often than maybe we think, that that's something that maybe people don't think about. And so we kind of dug into the data and started looking into it. And the more we looked at it, the more it looked like this choosing of when exactly I want to sell and whether I want to pay these taxes by selling stock doesn't seem to just be an afterthought, but it seems to actually be a way in which these corporate insiders might be able to potentially take advantage of their superior information that they have. If an executive just goes out and sells stock like you and I would in a brokerage account, they have to report that information. And the reason that we make them report that is because we know that the CEO knows a lot more about the company than I do as just a random investor. And so in order to make sure that we can sort of observe what they're doing and be able to see how they're trading while they have that information, executives have to report any trades that they make. So if they go out and make a sale, they have to go tell everybody, hey, I made a sale. What's unique is that sometimes they can go make a sale, and if they say that it is for the purpose of covering their taxes, they get to report it in a different way. The way it actually works is they have a different code on their form that says, hey, this is not a sale necessarily, it just is trying to pay my taxes. Sometimes on the filing, they will actually say explicitly, this does not represent a sale. This is to cover taxes, even though mechanically it's an exact sale. So a lot of people for a long time have been interested in when an executive sells their stock, does that mean that they think that the company's going to do worse? Are they trying to sell their stock before the stock price goes down? And so most people, their kind of first pass at the data, they say, okay, I'm only going to look at sales, but they completely ignore these tax withholdings, these sales for tax purposes. One of the big contributions of our paper is saying, well, maybe those tax withholdings aren't just random or uninformative, right? Maybe those act as strategic sales. And so once we decided to collect this data and do our analysis, we really focused on when an executive receives an equity option and exercises that equity, do they sell for to cover the taxes or do they not? Do they keep all of their shares? And what we find is that if an executive sells the stock, that stock tends to underperform anywhere between 4 to 8% annualized over the course of the next year versus if they choose to keep all of the shares themselves. So basically, these withholdings, these sales for taxes that people generally have thought of as kind of an afterthought, do seem to actually predict what the company's going to do. And interestingly, when we actually look at trades within the period most close to an earnings announcement, what we do is we compare these tax sales to just other general sales, and we find that the regular sales actually aren't very predictive of what the firm is about to report about its upcoming earnings. But when they make these tax sales, these things that people pay a little less attention to, that actually predicts a worse earnings announcement by the company. Almost all companies know that insiders might trade on their private information, and so they put in policies. Almost 100% of companies put in policies that restrict insider trading in some way before these earnings announcements. But only about a third of companies actually restrict these tax sales. And so we find that actually these tax sales also seem to be a potential way that insiders can use that information. So we think about policy implications. I think a very potentially relevant policy implication is, as a firm, if I'm designing my regulations and my policies, considering adding these as well to sort of things that maybe need to get pre-approved or things that we're only going to allow companies and insiders to do at certain times. And then from an SEC perspective, just really helping them potentially identify more ways in which corporate insiders are potentially using this information that they're not allowed to be using, and things to be on the lookout for.
Right. So, people always ask me why I'm interested in issues around insider trading or what insider sales or not selling, what that means or what kind of implications it has for policy. Well, there are two groups of people that are interested, besides academic researchers, of course, in this research. So if you think about most firms, to investors, a firm will always be a little bit of a black box, right? We don't know exactly what investments the firms are making or what internal decisions that they're making. So investors very often look to trades that insiders make to get an idea of what the executives actually think about the prospects of the firm, right? In this particular case, we essentially find one aspect of insiders making decision on whether or not to sell their stock that nobody else had thought about before, and we show that this says something about what executives think about how well or how not well the firm is going to do. So that's one bigger, broader context for why we're interested in these kinds of questions. Now, as you said, well, there is also the regulatory aspect of this. So here in the US, executives are allowed to buy or sell shares in their firms. But we've taken the position, I guess as a country, through our regulations, that we don't want these executives to be able to just buy and sell based on material information, because if they can do that in a way that allows them to profit at the expense of potential investors, investors won't invest in the stock market in the first place. And you won't have the capital accumulation that the country needs to actually make investments in products, in processes that will ultimately benefit all of us. So part of what the regulators, especially the Securities and Exchange Commission, part of their charge is to make sure that executive selling does not get so out of hand and that they're not exploiting outside investors to the extent that those outside investors never want to invest in corporations and provide capital for investments by these corporations. So regulators are always on the lookout for ways in which executives try to benefit at the expense of potential stockholders. And our paper actually finds a way that I think regulators had overlooked, which is that it's not just when investors or when executives buy or sell their stock that they're signaling what they believe are the prospects of the firm, but even when they do something they're allowed to do, by the way, which is sell stock to cover their taxes or not sell stock to cover their taxes, even those activities signal something about what executives think about the firm. So again, if you think about policy, investors like to know what executives think about the prospects of their firm, and we uncover one way by which investors can get that information or get that signal. But regulators too also like to know ways in which executives are exploiting their private information at the potential detriment of outside investors. Now, I will note, and this question very often comes up, that are we uncovering some kind of illegal behavior? That's not the case because, illegal behavior, there's a very high standard, there's a high threshold by which executives end up being charged for insider trading or engaging in illegal behavior. But what I think we document here is an example of informed trading using what we think is a fairly legal mechanism, at least at this point in time. This is absolutely legal. They have that choice. It's entirely up to them. However, we find, and we actually document this in the paper, that that choice very often says something about what those executives think are about the immediate future prospects of their firm. So at one point, earlier in the year, the executive had one of these equity awards vest. And at that point, the executive decided to sell stock in their firm to cover those taxes. Our view was that that executive kind of had an idea that maybe there was some bad news. And if you think about it, if there's bad news, the stock price is going to go down. You want to sell your stock at a high price if possible so that you can cover your taxes with valuable stock because you know that stock price is going to go down. And we do find that shortly after that executive made that decision, the firm reported some bad news and the price went down. Now again, same executive later in the year also had an equity award vest. And at that point, the executive chose not to sell stock to cover the taxes that were owed. The executive chose to hold on to the stock and we think at some point paid with cash. And our view was that at that point, the executive knew that there was good news that would increase the value of the stock. So why not just hold on to the stock? Because you're still going to owe the same amount of taxes, wait for the stock price to go up. And you're essentially paying the taxes with only a fraction of stock price that has gone up. And we do find, lo and behold, after that particular incident, the firm announced that they were going to be purchasing shares, which is very often accompanied by the stock price going up, and the stock price went up.
And I think you bring up a couple of good points too. I think one thing that is definitely important to remember is that these are completely legal transactions that they're making, and it's not obvious what potentially the correct policy prescription might be because some of these equity awards are really big.
Yeah.
And so you can imagine that not everybody has enough money just lying around. Like it is a practical way that you can potentially sell shares. So I think one of the potential benefits of our paper is just helping inform that this mechanism is potentially something that's being thought about and something that companies and regulators and investors should definitely be aware of. And you talked a little bit about the actual amount of tax that they owe. That reminded me of one of my favorite tests that we do in the paper to try to understand. One of the hard parts of this area of research is that you can't ever really get into the mind of an insider. You don't know exactly what a CEO or CFO is thinking about. And so one thing that we look at is we look at when the state tax rate that an insider lives in changes. And what we find is that if the insider's state tax rate increases, that same insider, when they choose to sell for taxes, it is a better predictor of upcoming stock returns. So one way to think about that is if the size of the trade is increasing, if all of a sudden I owe more taxes, I might think a little harder about, do I want to sell my stock today? Like, what do I think the stock price is going to do in the future? Do I want to use stock to pay for this or use cash? And that's one of my favorite tests in the paper because it really is kind of a good way to look at the same person. The only thing that changes is how much tax they're actually owing because the state tax law changed and we see a change in there, the informativeness of these withholdings.
Again, we're not saying that every executive out there chooses to strategically withhold or not withhold. Obviously there are individual preferences, and some executives, are more likely to exploit this than others, either for, their own personal moral aversion to trading at the expense of stockholders, or a fear that, if somebody finds out about this, it might be bad for their reputation, right? So we're not making that claim, and we're sure there's some executives who never do this. But it is, again, important to highlight the fact that when every executive gets a stock award or an option award, at some point when that award vests, they do have a choice. They have to pay taxes, that's the law. And at that point, they are also required by the law to make a choice. And, as you just said, we find, which is kind of a cool discovery, I think, that when the potential financial impact is higher, when those executives do have to pay a higher amount of tax, they're more likely to strategically use the withholding in a way that signals something about what they think about the prospects of the firm.
And that is another good point to really emphasize that our paper does not say that every corporate insider is doing this. In fact, we do find a relatively good number that pay taxes very similar to I do, potentially you do, where they seem to not really think much about it. They do the same thing every single time. They either always sell, they always retain it all and pay with cash. So this is definitely not something that is happening everywhere all the time, but still something that is worth monitoring by regulators and investors.
Now, one other cool thing that we find is that the executives who are more likely to strategically withhold or not withhold taxes, depending on what they think the prospects of the firm are also the executives that are ultimately more likely to face some kind of regulatory sanction or investigation by the SEC, usually for other things. Because again, keep in mind that your choice of tax withholding is not only required, it's perfectly legal, right? You simply just choose to withhold or not, right? But what we find is that the executives who choose to exploit this loophole, so to speak, of trading in a way that allows them to benefit from their private information are ultimately more likely to engage in other types of potentially illegal or less legal things, and are ultimately more likely to face some kind of SEC investigation down the road. Again, usually for other things, right? Suggesting that, again, not all executives do this, but the ones who do this are somewhat more likely to face some kind of SEC investigation down the road.
And an additional point to that is another test we do is we look at the year that they actually get investigated, the year of the lawsuit when these insiders eventually get sued by the SEC. Again, even though they're being investigated for something completely different, we show that their withholdings become not strategic anymore at the time of investigation. So while they know that they have eyes on them, all of a sudden that withholding, that sale for taxes doesn't really inform us about what the upcoming stock price is going to be.
Yeah, so when they think that there might be somebody looking up over their shoulder at everything they're doing in general, all of a sudden they're less likely to engage in this kind of behavior
Yeah.
in general, which again sort of speaks to the idea that while it's legal, it is obviously the case that the executives who are doing this strategically are doing it because they want to benefit from their private information. So in those years when there are people basically in the company investigating the company for all kinds of other things, they're less likely to engage in this behavior, which I think again is another really cool aspect of this research. And it's one of those things that made Ryan and I really excited to work on this paper. And the way we came up with this research, sort of underlies why I think Kansas is such a great research environment and how students who come to the University of Kansas benefit from learning at a research university in a way you wouldn't get in other universities. And we believe here that a big part of being a great instructor is that you're also working at the forefront of research and thinking about current problems in research, because that way you're also bringing some of that to the classroom and you're helping prepare students for the problems they're going to encounter many years down the road and not just preparing them for their immediate careers. The other thing too that I want to highlight about this is that because you mentioned that you took my class on insider trading, one of the things that I was able to do because I'm at a research university is I was able to go spend some time at the Securities and Exchange Commission and actually worked on insider trading. I brought my research to that position, but I learned some things from that position that I was able to bring to the classroom, and you benefited from that.
And I think that's a really good point too, because one thing that I have found in teaching my classes is that students really enjoy being a part of that process. A lot of times I think students sometimes feel like the professor knows everything and they are the ones learning. And so when I'm sharing with them this idea that I'm also trying to solve questions that we don't know the answer to, they really were interested in that, and particularly related to insider trading. I think that's a topic students generally find a little more interesting. And so I had a lot of students coming up and talking to me and asking me questions, and we're really kind of getting excited that they were almost getting to learn at the same time I was as we were trying to solve these problems.
So the research obviously builds on some of my previous work on insider trading as well. And you found a great way that we worked on together to extend that research.
But then one thing I really appreciated was after we collected the data and kind of had our preliminary analysis, we brought on another co-author, one of your contacts who's currently at the University of Nebraska-Lincoln as well. And both of you really prioritized the fact that I was going to be coming up on the academic job market. And so a more polished, further along paper really was important to me and my success. And so even though obviously you were plenty busy and had plenty of things on your plate, you both really emphasized the importance of prioritizing this project because you knew how important it was for me and helped me eventually land the job that I was hoping to get.
As a professor who has to work with doctoral students, I view my role as being twofold. So on one hand, I am teaching the students how to do great research. And very often, one of the best ways to teach students how to do great research is to work with them on a research paper. Another important role that I think I have here is connecting students with the broader academic world. And part of why I brought an additional co-author into the paper was to also give you an opportunity to meet another researcher at another institution Yes, you have to have a good idea, but you're always building on other people's work. And the best ideas, the best executed papers are very often collaborative pieces that bring in skills and knowledge from various people. So I viewed my role in this as, yes, I did want us to publish a really great, cool idea, but I also wanted to help develop your research skills. And we're really proud of what Ryan has done. And you're a great example of what we try to do in our PhD program in terms of great collaborative work between students and faculty, but also, great skill building and a great outcome in terms of your placement coming out of our PhD program.
I am originally from Kearney, Nebraska, and when I decided I wanted to pursue a PhD, I really liked the idea of trying to stay relatively local in the Midwest. And so I really emphasized, as I was looking at potential programs, searching for Midwest schools. And when I got to come visit Kansas, it really was a perfect combination of that regional preference, but really got to know the faculty well and having an opportunity to be close to family, but work with world-renowned faculty that really prioritize student success early was something that I felt and eventually resulted in a lot of success for me, really learning what it means to be in higher ed and be a researcher and a teacher. My first day in the PhD program, I had my intro finance seminar with Felix Meshki, who was one of my advisors in my dissertation chair. One of the first things I told him is I would love to go work at the University of Nebraska-Lincoln when I graduate. Getting to be a professor at the flagship university was something that has really been a dream of mine. And he looked at me and said, we're gonna have to work hard at that and you're gonna have to work at it. And I certainly did, but really kind of from the onset, I said that that was my objective, and the faculty and other students and just all the resources at KU really put me in a position that targeted me toward preparing me to potentially have that outcome. One thing that's hard about the academic job market is you don't necessarily know who might be hiring. It's a very competitive process. So when my time came to be applying, I applied everywhere in the country. Luckily for me, the University of Nebraska-Lincoln was hiring, and then I got that phone call, and I was so excited to go tell all of the faculty and my advisors. I actually locked myself out of my office and had to have my office mate Matt come back and let me in. It felt like everybody was celebrating with me and was just as excited for it as I was, which really meant a lot to me because that was really the dream outcome for me.